Greetings, my name is Ezra Farrell and I'm part of the first group that will present a material for Intermediate Accounting 2, which is PSAK 56, which is presented by Ezra Farrell of Febriansyah, which is me. The second one is Aldrin, Charis, Rorong, and the third one is Keisya Novera. So we should just proceed to the first material, which is earnings per share. So earnings per share indicates the income earned by each ordinary share of the company. So the purpose is to establish the principle for determining and presenting earnings per share, and the scope is to individual entity financial statements and consolidated financial statements of a group with a parent entity. This is the formula for earnings per share, which is net income minus preference dividends and weighted average ordinary shares outstanding. So net income minus preference dividends, so profit adjusted by the amount of preferred dividends after tax. So the difference resulting from the settlement of preferred shares and other similar effects of preferred shares classified as equity. The next one is weighted average ordinary shares outstanding. So the weighted average or number of ordinary shares outstanding during the period is the number of ordinary shares outstanding at the beginning of the period adjusted for the number of ordinary shares repurchased during the period. So multiplying the number of shares outstanding during the period by a time weighting factor. So the time weighting factor is the number of times a group of shares circulates compared to the number of days in a period. So in general, shares are included in the calculation of weighted average number of shares from the date of collectibility, such as the first one is ordinary shares issued through sale with cash are accounted for from the time the cash is received. And the second one is ordinary share issued upon a voluntary investment of ordinary or preferred share dividends. And then the third one is ordinary shares issued as a result of the conversion of debt instruments into ordinary shares are accounted for from the date the debt ceased to bear interest. And then the fourth one is ordinary share issued in lieu of interest or principal on other financial instruments is accounted for from the date the debt ceased to bear interest. So the fifth one is ordinary shares issued in settlement of liabilities of the entity are accounted for from the date of settlement. And then the sixth one is ordinary shares issued in exchange for the acquisition of non-cash assets are accounted for on the date the acquisition is recognized. And the seventh one is ordinary shares issued as payment for services to the entity are accounted for from the time the services are received. And then ordinary shares issued as part of the consideration transferred in a business combination are accounted for in the weighted average number of shares from the date of acquisition. And then contingently issued ordinary shares are considered as outstanding shares and are included in the calculation of basic earnings per share only from the date all necessary conditions are met. For example, the event has occurred. So the weighted average number of ordinary shares outstanding during the period and for all periods presented should be adjusted for events other than the conversion of potential ordinary shares that have been changed the number of ordinary shares outstanding without an accompanying change in total power. So the first one is capitalization of profits or issuance of bonus shares known as share dividends. The second one is bonus element in other share issues. For example, bonus share in rights issues to existing shareholders. The fourth one is share split and the fifth one is reverse share split. So diluted earnings per share. So the company calculates diluted earnings per share for the amount of profit or loss distributable to ordinary shareholders of the parent entity, and if presented profit and loss from continuing normal operations attributed to such shareholders. So for the purpose of calculating diluted earnings per share, the company adjusts the profit or loss attributable to ordinary shareholders of the parent and the weighted average number of shares outstanding for the effect of all dilutive potential ordinary share securities. So these are the earnings per share formulas. So the first one is earning per share, the basic one, and the second one is diluted EPS, which includes net income minus preferred dividend paid out to dilutive securities and weighted average number of common shares outstanding plus conversion of dilutive securities. and dilutive effect of ordinary shares. So the potential ordinary share effect is dilutive if its conversion into ordinary share will decrease earnings per share from continuing normal operations. Anti-dilutive, if converted into ordinary share, will increase earnings per share from continuing normal operation. So determine whether potential ordinary shares are dilutive or anti-dilutive. An entity uses profit or loss from normal operations attributable to the parent as the control number. So in determining whether potential ordinary shares are dilutive or anti-dilutive, each issue of potential ordinary shares is considered separately, and the order in which potential ordinary share securities are accounted for may affect whether they are dilutive. So to maximize the dilution of basic earnings per share, each share issue should be considered in order from the most dilutive to the least dilutive. So options, warrants, and similar financial instruments. So options and warrants are dilutive if the ordinary share price is less than the average ordinary share market price. So in calculating diluted earnings per share, financial instruments with potential ordinary shares have two treatments. So the first one is if the issuance of ordinary shares is at their average market price and the shares are assumed to be fair valued and no dilutive or anti-dilutive, then the instrument is ignored in the calculation of diluted earnings per share. So if the issuance of the remaining ordinary shares that do not generate any proceeds, so the shares do not generate any proceeds. Therefore, the shares are dilutive and added to the number of ordinary shares outstanding to determine the diluted earnings per share. So to calculate diluted earnings per share, the entity assumes all options and warrants are dilutive. So the difference between the number of ordinary shares issued and the number of ordinary shares to be issued at the average market price of ordinary shares during the period is considered to be an issue of ordinary shares for no consideration. So the total dilution is average market price of ordinary shares during the period and minus issued price.
So we have the example for treasury shares method, and the example is PTOK has 2,000 option outstanding with an exercise price of 400 rupiah, and the fair value of the shares to be issued is 500 rupiah, 500,000 rupiah. What is the assumed increase in the number of ordinary shares outstanding? An increase in number of ordinary shares outstanding equals fair price minus option price divided by fair price multiplied by number of option shares, and it equals 500,000 minus 400,000 divided by 500,000 multiplied by 2,000 pieces, and the answer is 400 shares of ordinary share. Next, we have the example for diluted EPS example. So suppose a company recorded a net profit of 2,500,000 rupiah in 2018, and the company had 1 million weighted average shares outstanding during the year and paid tax at a rate of 40%. And the company also has 1,000 convertible preferred shares outstanding, which pay a dividend of 50 rupiah per preferred share annually. And each preferred share is convertible into 100 ordinary shares. And the formula for this problem is net income minus preferred share dividend plus convertible preferred share dividend and divided by weighted average number of share outstanding plus new ordinary share issued after conversion. And we can put the number in. So 2,500,000 rupiah minus by 50,000 rupiah plus by 50,000 rupiah and divided by 1 million plus 100,000. And equals 2,500,000 rupiah divided by 1,100,000 rupiah. And we get the amount of the EPS is 2.27 rupiah. And next, we have the basic EPS example. So we have the formula here. So earning per share, we can get earning per share by net income minus preferred dividends and divided by weighted average ordinary shares outstanding. So we have the net income, 2,500,000 rupiah, and we have the preferred dividends, 50,000 rupiah, and 2,500,000 minus by 50,000 and divided by 1 million. So we got 2.45 rupiah. Next, we have diluted EPS. And diluted EPS presentation is the company must present the basic LPS or loss per share and diluted earning per share in the income statement for all periods presented, and presentation of basic and diluted earning per share must still be done even if the amount is negative because the company suffers a loss or loss per share. And for the disclosure, the company should disclose the following amount of profit or loss used as a numerator in the calculation of basic and diluted EPS and its reconciliation to profit or loss for the period, and weighted average number of shares outstanding used as denominator in the calculation of basic and diluted EPS and reconciliation of denominators to each other. And if the per share calculation reflects a change in the number of shares, they should be disclosed. In addition, basic and diluted EPS for all periods presented in the financial statements should be adjusted for the effects of fundamental errors and adjustments arising from changes in accounting policies and the effect of business combinations that constitute a consolidation of ownership. And we have the restatement here. And if the number of ordinary shares or potentially ordinary shares rises with the issuance of bonus shares or capitalization of IGO shares, share dividend or capitalization of profit or share split, and decrease due to reverse share split. Therefore, the calculation of basic and diluted EPS for all periods presented should be adjusted retrospectively if the change occurs after the balance sheet date, but before the financial statements are issued. Then the per share figures for the entire financial period presented should be based on the new number of shares outstanding. And we got the exposure draft of PSAK 56 R 2010. The entity calculates the basic and diluted earnings per share amounts of the profit or loss attributable to ordinary shareholders of the parent entity, and if presented, the profit or loss from continuing normal operations attributable to those ordinary shareholders. Basic earnings per share is calculated by dividing the profit or loss attributable to ordinary shareholders of the parent entity by the weighted average number of ordinary shares outstanding during the period. And for the purpose of calculating diluted earnings per share, the entity adjusts the profit or loss attributable to ordinary shareholders of the parent entity and the weighted average number of shares outstanding for the effect of all dilutive potential ordinary share securities. And this statement applies to the entity's individual financial statement and the consolidated financial statements of a group with a parent entity. And when an entity presents both consolidated and separate financial statements, the required disclosures are based only on consolidated information, and entities that choose to disclose EPS under separate financial statements present the EPS information only in their statement of comprehensive income, and entities should not present such earnings per share information in the consolidated financial statements. And if the entity presents the profit or loss component in a separate income statement from PSAK 1 R 2009, then the entity presents earnings per share only in the separate income statement. And we have the comparison here from PSAK 56 2010 versus PSAK 56 1999. And this difference can be seen from various aspects, namely in terms of scope, basic and diluted EPS, and contract that can be settled with ordinary shares or cash, and put options issued. And the scope difference from PSAK exposure draft PSAK 56 revised 2010, the presentation of earnings per share should only be presented in a separate income statement if the entity presents the income component in a separate income statement. And the scope in PSAK 1999 is unregulated. And the basic and diluted EPS, the difference from PSAK 56 revised 2010 between PSAK 1999 from exposure draft PSAK 56 revised 2010, basic and diluted EPS is attributable profit or loss, and if presented profit or loss from continuing normalized operation attributable to ordinary shareholders of the parent. But PSAK 1999 is unregulated, and contracts that can be settled with ordinary share or cash. For PSAK 56 2010, they set up contracts that can be settled with ordinary shares or cash at the entity's choice and the choice of the contract holder. But for PSAK 1999 is unregulated, and written put options for PSAK 56 2010, they set out the treatment of contracts that required an entity to buy back its shares. And for PSAK 1999, it's unregulated. And exposure draft PSAK 56 revised 2010 for the calculation of basic earnings per share, the amount of profit attributable to ordinary shareholders of the parent entity relates to profit or loss from continuing normal operations attributable to the parent, and profit or loss attributable to the parent entity, and the sum of A and B adjusted for the amount of preferred dividend after tax, and differences arising from the settlement of preferred shares and other similar effects of preferred shares classified as equity. And dilutive We have dilutive ordinary shares, potential securities. Uh, there is options, warrants, and similar financial instruments, convertible instruments, contingently issuable shares, contracts settlable in ordinary shares or cash, purchased options, written put options, and we have contingently issuable shares. And contingently issuable ordinary shares are considered as outstanding shares and are taken into account in the calculation of diluted earnings per share if the conditions are met. And example, the event has occurred. And if the condition is not met, the number of contingently issuable ordinary shares is based on the numbers of shares that would have been issued if the period end had been the end of the contingent period. So for the next material, we'll explain by Aldrin. Thank you.
Okay, in this slide, there are two types of contracts that can be settled with ordinary share or cash. The first one is the entity considers that the contract will be settled in ordinary shares and the resulting potential ordinary shares are included in diluted earnings per share if the effect is dilutive. And the second one is cash settlements and more dilutive shares used in the calculation of dilutive earnings per share. Next slide is write and put options. In the write and put options, that contract that require the entity to repurchase its own shares, such as put options issued and forward purchase contracts, are reflected in the calculation of dilutive earnings per share if they have a dilutive effect. The potential dilutive effect on earnings per share is calculated as follows. The first one is assume at the beginning of the reporting period, a number of ordinary shares will be placed to raise funds to fulfill the contract. And assume, again, the proceeds from the share issuance are used to fulfill the contract. Okay, options purchased. Options purchased. The contracts such as put options and call options purchased by the entity are not included in the calculation of diluted earnings per share, as including such options may be anti-dilutive. Comparison with IFRS. In the PSAK 56 revised 2010, earnings per share adopts at all provisions of IAS 33 earnings per share as of January 2009, except the first is the scope of separate financial statements is not adopted because the setting is adjusted to PSAK 4 in revised 2010, consolidated and separate financial statements. And the last but not least, the effective date is not adopted because it is not relevant. Okay, thank you for your attention and to watch this video, and thank you guys.